One of the best accounts for building your wealth is a Roth IRA, but not knowing how to properly use it can cost you tens of thousands of dollars in the long run, paying penalties and fees. That's money that could be going back into your investments and helping you reach your money goals much faster. So in this video, we'll be going over the mistakes that you should avoid in order to maximize the value you get from your Roth IRA and avoid having to pay any costly mistakes. Hey, I'm Kevin, and on this channel, we talk strategies to help you along on your financial journey. If you love saving on taxes, let me know by hitting that like button and let's get into it. Very briefly, let's go over what a Roth IRA is. An IRA is an individual retirement account, which are accounts that have tax benefits to help people like you and I save for retirement. The Roth IRA is a type of IRA that lets you contribute after-tax money, so money you keep after you've already paid your taxes, and then any growth you have on that money is tax-free. This is amazing because that means that you don't have to pay taxes later down the line when you're likely making more money and are at a higher tax bracket, compared to, say, a regular investment account, where yes, you put in after-tax money, but any gains you have on that money is also taxed. However, with all good things, there's a catch. And the catch here is that you can only contribute either $6,000 or $7,000 to this account every year. If you want in-depth details on the Roth IRA or the traditional IRA, check out my video that dives deep into that topic. Moving on to the first thing you should avoid with Roth IRAs is, well, not having one. I believe that the Roth IRA is one of the first places you should put your extra money after having already contributed to, say, a employer matched 401k retirement account. Although some people think that because they already have an employer-based 401k that they don't need a Roth IRA, which is not really true. Yes, you should contribute to your 401ks if there's employer matching to get that free money, but apart from that, Roth IRAs actually have a lot of benefits as well. If you look into your 401k account, you'll likely see that it's limited in what type of investments you can buy into. And for me personally, my employer-based 401k account only lets me invest into 22 different funds. The Roth IRA doesn't have this limit and is a lot more flexible because you can buy into any type of investments you want. A Roth IRA account is also an individual retirement account, so that means it sticks with you wherever you go. Whereas with a 401k account, you have to deal with different things if you change employers and things like that. Nowadays, with how easy these accounts are to set up, there's no real excuse to not set one up for yourself. You could use services like Fidelity, which is a company I use, Schwab, or even Vanguard, which are the three popular ones. Now, the second thing to avoid is not starting early enough or not contributing enough. As with all investing, the best time to do so was yesterday, but the next best time is today. And that's especially true in a tax-free account where you can compound your growth. Just delaying by 1 year could cost you over $100,000 by retirement. Say you want to retire when you're 60. If you start investing $500 a month, so $6,000 a year, which is the Roth IRA limit, with an average return of 8% year over year, you'll have $1.55 million. Now, if you delay your start by just 1 year, you'll only have $1.43 million. Yes, that difference is huge because of compound growth. Another way to look at it is that you have time in your favor. You may not have the currency of dollars, but you do have the currency of time, so use that to your advantage. Now, instead of contributing too little, the third mistake to avoid is contributing too much. A Roth IRA limits you to contributing $6,000 or $7,000 a year of your earned income. That's any income that you earn from working for an employer or working for a business you own. That means if you're a stock trading genius and you make all of your income buying and selling stocks and having capital gains, none of that is eligible because capital gains doesn't count as earned income. So keep that in mind. If you do contribute more than you should, you want to catch that and fix it right away, because any extra contributions, you'll be paying 6% penalty every single year until that's fixed. That's a lot of penalty to pay. No one's keeping track of how much you put into your Roth IRA. So if you have something like automatic depositing, make sure that it's not depositing more than your allowance every year. Or if for some reason you have multiple Roth IRA accounts across different companies, you're the one that is responsible for keeping track because your contribution limit of 6,000 or 7,000 is across all of your Roth IRAs, even if they're spread among a bunch of different accounts. Number 4, if you're married, make sure that you're contributing to your spouse's Roth IRA if they aren't doing so. The IRS says that if your spouse doesn't have earned income to contribute to the Roth IRA, you as their spouse can do so for them instead. Say your spouse is a stay-at-home and doesn't have earned income to contribute, make sure you take advantage of this because that's another $6,000 you can contribute to have these tax advantages. Just make sure that you have enough earned income to contribute to 2 Roth IRA accounts, meaning you need at least $12,000 of earned income in that year. Now, along with that is a bonus tip, which is not really talked about, where if you're in a situation where you're married but you're filing your taxes separately. Maybe it makes sense because of your income situations, or someone has a large out-of-pocket medical expense or other tax benefits that made you do so. In this case, make sure to not over-contribute, because if you're married and filing separately, you're only allowed to contribute to your Roth IRA if you make less than $10,000. Yes, that's $10,000, which is not a lot, because the IRS really discourages married couples from filing separately. On to mistake number 5 to avoid, which is withdrawing too early. Roth IRA accounts are made for you to save and compound your growth for retirement, which is why there's so many restrictions on withdrawing early before you're 59.5 years old. For example, if you decide to withdraw your entire account before then, you'll be subject to paying income taxes and a 10% penalty on top of that, basically wiping out any benefits that the account would have given you in the first place. However, the Roth IRA is flexible enough where you can take out your contributions, so your $6,000 you put in every year, without any issues. Either way, you shouldn't really be drawing from this account early unless you absolutely need to, because you'll be cutting into your principal and eating into any compound growth you would have. And if you get in the habit of withdrawing from this account once or twice, you'll get comfortable and get in a habit where it's okay to keep withdrawing from that account, which is not a habit you want to have. Alright, number 6. The next mistake you want to avoid is taking on too much risk in this account. Again, your Roth IRA is an account made to help you save for retirement, not a place that you're supposed to YOLO your money into high-risk investments like GameStop call options. There's a reason why employer-sponsored 401k retirement accounts limit you to a select basket of investments you can invest in so you don't blow your whole account up. And because you only have that much contribution room every year, if you lose a big chunk of that or all of the amount, you won't get your contribution room back, meaning you have to start over again from square one and basically restarting the clock for your compound growth to happen. And number 7 is the mistake of investing in funds that have really high fees. There are a ton of different funds you can buy into, mutual funds, index funds, and ETFs. But you really have to choose the right ones in order to maximize your growth over the long run. If you want to know which type of funds are the best to invest in and examples of some of the ones I recommend, check out my previous video that breaks down to 3 different funds. Basically, index funds and ETFs are probably the ones you want to go with, but you'll still have to search to find ones that have low management fees. The good ones can have as low as 0.03, 0.04%, but the bad ones can have as high as like 2%. That means if the fund was supposed to return 8% a year, which is the average for the S&P 500, then they'll be taking 2% of that, leaving you with only 6%. Just that 2% difference year over year means that by retirement, instead of having $1.5 million with the 8% growth, you'll be dropped down to just over $900,000 if you had 6% growth. That's a big difference. Alright, so the 7 things you want to avoid with Roth IRAs is number 1, not having one. It's so easy to get one nowadays that there's really no excuse to not open one. 2, not starting early enough or not contributing enough. Remember, you may not have the currency of dollars, but you do have the currency of time. Number 3 is over-contributing. Make sure that you're sticking to the $6,000 or $7,000 a year guideline and not contributing over that, because you'll be paying some hefty penalties. Number 4, not contributing and not utilizing your spouse's Roth IRA. If they don't have earned income and aren't contributing to it, make sure you take advantage and contribute to theirs for them instead. 5, withdrawing way too early, incurring penalties and fines, or eating into your compound interest. Number 6, investing in things that are too high risk especially because these accounts are for retirement. And lastly, number 7, investing in things that have too high fees, which could really eat into your growth over time. Hopefully by following those tips, you'll avoid paying a ton of penalties and fines and instead have that money reinvested in your investments, which will help you accelerate your financial plan. If you want to accelerate your Roth IRA growth by investing in the right funds, check out my previous video that breaks down different popular funds to invest into. Or if you're new and you want to learn a lot more about Roth IRAs and traditional IRAs, I have a video on that as well that breaks down the 2 different IRAs with all the similarities and differences you need to know. If you watched to this point of the video, thanks so much, and as always, invest safe and I'll see you in the next one.